The S&P 500 had the worst drop since COVID 2020, with recession fears heightening and around 3 trillion wiped off the stock market. When we take a look at the S&P 500, just over the last week, it is down around 2.5%, and we can see from the all-time highs of mid-July, it is down nearly 6%. Now, one thing we want to point out is that when we take a look at the historical data, what we can see over the last 30 years, August has been historically the second worst performing month in the stock market, and unfortunately the next month, September, has been the worst month, down nearly 1%. So this does show us that we could be in a continued bumpy ride over the next few months. And then when we take a look at the fear and greed index, we can see that we are very close to an extreme fear mark, which does mean there is a lot of current anxiety in the market and that a recession will take us into the extreme fear mark, and therefore the drop that we have seen in the market will continue at least over the next few months. So why has this happened? Let's take a look at some of the macroeconomic factors. First thing to note, we are seeing a lot of countries that are cutting their interest rates. The first one that we saw was the Bank of Canada, where they cut around 25 basis points around 2 weeks ago. Just last week, we saw the Bank of England lower their rates for the first time since 2020. So the question that is on every investor's lips are, what is it that the Fed exactly are looking for before they will start to cut those interest rates? And we have heard from many CEOs just over the last few days that talk about the Fed risking a recession, and unfortunately a lot of analysts do believe that it may be too little too late from the Fed, even if we do get the 50 basis point cut over the next few months. The interesting thing to note from the latest inflation report is that it did fall by around 0.1% in June, and that does take it now, as we can see, at around 3% over the last year, and that is the lowest level that has been seen in the US for more than 3 years. So this is really affecting the economy, as we just saw around $3 trillion wiped just on Friday from the stock market. Now, when we take a look at the wider consumer environment, what we have noted, a lot of large companies have reported their earnings, and they all talk about misses to their top line, and they essentially believe that the consumer is pulling back on spending. For example, when we look at McDonald's, they missed on both their EPS as well as revenue. And one of the most interesting facts that we saw was that the same store sales fell for the first time since 2020. And even though they are essentially bringing a $5 value meal, this hasn't helped them enough to hit those targets that the market does expect. Now, it doesn't just stop at McDonald's. When we take a look at Starbucks again, they also missed their revenue, and that is very telling. They in fact say that their same store sales also declined, and that was for the second straight quarter. So we're seeing weakness in McDonald's, we're seeing weakness in Starbucks. In fact, when we take a look at some of their notes from their earnings transcript, they talk about how the sales slump that they are seeing in their numbers will not be stopping anytime soon. So they see this happening for at least the next few quarters. Again, not just McDonald's, not just Starbucks. When we take a look at Procter & Gamble, who sell pretty much every single household good you can think of, whilst they did beat on the earnings, we have noted on the revenue they did come under what Wall Street were estimating. And what is very interesting to note with Procter & Gamble, as well as a few other company earnings that we're about to come onto, consumers are starting to pull back, not just on buying the items that they want from the labels like Procter & Gamble, but they're also starting to buy less of the items when they do move to cheaper quality. So there is a definite weakening of the environment that we are seeing by consumers. And one thing that we discussed not too long on the channel, even though Intel had an incredibly poor earnings, a few things that stood out was not only they issued lower guidance, but they are cutting 15% of their workforce, and clearly a lot of people are holding back spending, whether that's on laptops or any other products, and they are waiting to see how the recession unfolds, how the market as a whole will look over the next 12 to 24 months. So a lot of warning signs that we are seeing in the market, but the main question remains, is it too little too late, and is the crash just taking place now? Finally, just to drill this message home, Hershey also reported just last week, and they missed on the earnings per share as well as the revenue, and they also talked about a lot of customers not just pulling back from their own products, but also from the snacks and confectionery items as well. So very interesting to note. It is something that we should pay a lot of attention to because this is giving us a good indication not just where the market has been over the last few quarters, but where we should be expecting the market to move on over the next few as well. Now today, what we want to really focus on are some high quality companies that we do believe to be incredibly undervalued, and at what prices we do see them as ones that we should add to our portfolio. Now, the first one that we are taking a look at is Alphabet. Now, whilst this company does have a double buy signal and a hold from quant, we're going to run it through our own valuation model to give you our own perspective and analysis. Right now, it does trade in the midpoint or the mid to upper end of the 52-week range. And when we take a look just over the last month, it is down around nearly 10%. However, as we mentioned, over the last 12 months, still up around 30%. Over the last 10 years, would have significantly outperformed the S&P, up around 471. Now, they also pay a dividend, which is nice to note, although fairly trivial at 0.5%, and they do trade very cheaply at 21.78 when you compare it to the S&P 500 that sits around 22, 23, and we're about to look at the historical P as well to show you this does give us that undervaluation signal. Now, before we take a look at the underlying metrics of Alphabet and why we believe it should be a must buy, we want to just point out that even if we do see a recession inbound, one thing that you should never do is be scared, because when we look at the historical performance, it is always about time in the market in the S&P and not trying to time. So just to essentially digest this information, it is telling us that $10,000 invested in the S&P over the last 20 years, if you had just put the money in and you never took it out, it would be worth around $65,000. However, if you had tried to time the market and you missed 10 of the best days, well, that would have sit around $29,708. And in fact, 7 of the 10 best days in the market actually took place in the bear market. And as we can see, the more days that you did miss of the S&P's best ones, you would be down quite considerably. So ultimately, your investment returns are 93% lower if you miss 60 of the days and you try to time the market. And we can see here the depiction of some of the best days. And if you are familiar with the dates, some of these actually took place in the bear market. So do bear in mind, it is never great just to sell your portfolio, start to panic. But as always, do your own due diligence before deciding and never rely on someone else's investment thesis. We're going to run through very quickly some of the underlying metrics for each one of these companies. Dividend safety score, now they just recently started to pay, so it is an 80 safe score. What we typically like to do here is compare this company against the yield that it has offered over the last 5 years to give us dividend yield theory signals. However, they've just started to pay, so we won't focus on that. But as we mentioned, the forward PE does sit around 20.7. That is lower than the 5-year average of 23.5. So that is one of the undervaluation signals that we like to note. But bear in mind, we're not looking at this in isolation, and we will take a look at our valuation model. We do note, though, the communications sector as a whole is much lower, but Alphabet is a very high quality company which does deserve that premium valuation. Then when we take a look at some of the metrics, the first one is the free cash flow. Now this is below 20%, in fact 12 over the next 12 months. We want to see below 60%, so we do anticipate Alphabet to offer some very nice growth to their dividend on the year-on-year basis. Next thing that we look at is free cash flow for each company, consistent increases over the longer term, something we see with Alphabet, and as we can see, anticipated to increase over the next 12 months as well. Then we look at the sales growth, minimum 3 to 7%, pretty much double digit every single year, always a great sign. 9 in the more recent period, 13% on a trailing 12-month basis. And when we do take a look at this numerically, we can see not only has it grown at a very rapid rate over the last 10 years, but even in the more recent years as well, that growth doesn't look to be slowing down. As always, returning excess cash to investor pockets is a great bonus, and we can see over the longer term, they have been buying shares and pretty much starting from around 2018 at a very decent rate. You could argue fairly trivial, but as always, it is a bonus rather than having no share buybacks, or in fact, even worse, share dilution. We then move on to the ROIC. Now, we want to see 10% or more. Give us faith management are able to effectively allocate their capital. Very strong over the longer term, 28% in the more recent year, 31 on a trailing 12-month basis. Does show us that this is a very high quality company and one we should definitely consider. Margins also looking great on the operating side, above the minimum 12% and increasing, although marginally over the longer term. That is a sign of operating efficiency. Remember, high quality companies, increase to the revenue, increase to the margins, that is what we want to see. Free cash flow consistently strong above the minimum 5%, 23 in the more recent year. Finally, the last metric, and probably one of the best, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. Maximum 3 is what we want to see, and the numbers below are the number of years it would take Alphabet to pay off their debt net of cash on hand, and this correlates to both balance sheet strength and dividend safety. It wouldn't even take them 1 day to pay it off over the last 10 years and over the next 12 months. So very, very strong. Definitely one we would recommend to consider for the portfolio. Then we get into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. And how we got to the $188 mark, we ran it through the DCF model. We have the free cash flow year on year. Now the average growth sits around 24%, and we have gone for 3 different rates, a low, medium and high, 10, 15, 20, and in fact today we want to be very conservative. We've gone for 10%, which we believe to be extremely conservative, not just lower than the average, also lower than the more recent year. With the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and as you can see, 188, which does indicate around 13% upside from the current trading price. Now you could argue that is way too conservative, and at a 15%, just for transparency, it does come to $264, which would imply 59% upside. Then we go to around 20%, and as you can see, for those that are fairly optimistic, around $371. That is more than double the current trading price. So a very nice price right now if you do believe that is the expectation moving forwards. So what we'll do is we'll put the 10% in. Do remember though, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers or essentially those in your portfolio or watch list. We then always use a margin of safety. We'll start off with 10% and execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics and good forward-looking data. Now you could argue Alphabet has all of those, so it is a buy at around $169. And to be honest, we've been very conservative today with around 10%. So for me, this sitting at a 10% MOS does scream to me a very good buy around this level, which as we can see, the current price isn't too far off. Now Wall Street themselves also fairly bullish. Their price target $209, which does give upside of 26%. Now for those that want to see around 15% MOS, that is at the $160 mark, and in my opinion, if you can grab Alphabet at around 160, this is definitely a must buy, especially given the very cheap valuation, not just over the last 5 years, but when you do look at this in comparison to the S&P, it trades lower and has historically outperformed by a very large distance. As always though, do let us know your thoughts below as we go along these today. Before we move to the next one, just to let you know, we have released our latest weekly articles. If you want access to this or any others, click on the pinned comment below and you can sign up and read straight away. And in our more recent one, we released an Excel spreadsheet looking at 35 undervalued stocks to buy for August, and we also talk about those that we hold within our own portfolio. The next stock to seriously consider is Amazon. Now this is down around 9% just yesterday, and we can in fact see a buy rating from Seeking Alpha, a strong buy from Wall Street, and a hold from Quant. Now it does trade pretty much bang in the middle of the 52-week range, with the forward P sitting around 36, and when we take a look over the last month, it is down around 14%, over the last year up 31%, over the last 10 years, another one that has significantly outperformed the S&P, up 930%. Now, in terms of the metrics, again, it does meet all of the criteria we want to see. Very nice free cash flow growth over the longer term and increasing massively over the next 12 months. Sales growth double digit nearly every single year, and numerically we can see a very great sign here. The numbers continue to show us that this is still a very nice growth story. One thing that we do want to point out that they do dilute your position over the longer term, but as always with the share price return in the same period, that probably wouldn't bother you as an investor. ROIC also looking fairly strong over the last few years, a little bit inconsistent, but nice to note 10% in 23, 14% on a trailing 12-month basis. Margins both looking okay, something we would like to see them improve over longer term, but as we can see, operating efficiency as it has been increasing, and free cash flow margin does on average sit around the minimum 5% level that we do want from companies we like to invest. Net debt to EBITDA as well, 0.61 in 23, 0.43 over the next 12 months. Not as strong as Alphabet's balance sheet, but still a phenomenal company. And as we can see, the balance sheet still does look very secure. So in terms of the valuation for Amazon, around $226, not too dissimilar from Wall Street price target at 225, where they see upside of 35%. Now again, for transparency, how we got to this price, for the DCF model, we had a low, medium, and high of 15, 20, 25. Bear in mind, this company is anticipated to increase its free cash flow massively over the next few years. We've gone for that 20% rate, and as we can see, 226 giving us upside of 35%. Now you can also see, depending on which rate you do believe to be more representative, the different upsides or downsides for this company. So at this 226 rate with a MOS of 10%, it does look to be a buy at $204. At 15%, 192, and then we keep going till it's near the current trading price. And in today's episode, we believe this is a screaming buy, 25% MOS, 35% upside from Wall Street, and as we can see, that is around $170. And as always, let us know your thoughts. I know a lot of people did add just yesterday, and in my opinion, one of the best buys in the market so far. We then move on to the next one, which is Meta Platforms, another buy from CK Alpha, strong buy from Wall Street, and a hold from Quant. It's trading towards the upper end of the 52-week range. It also has a yield 0.41% and a forward P, which pretty much sits now in line with the S&P. Now over the last month, this one is down, although marginally in comparison to the other two at around 3%. Over the last 12 months, up 55%. Over the last 10 years, again, another strong outperformer of the S&P. Now it does have a dividend safety score of 70, again very similar to Alphabet, just recently started to pay a dividend. And when we take a look essentially at this company, more importantly the forward PE, it does sit at 22, which is pretty much in line with the 5-year average of 22.3. In terms of free cash flow payout, again very similar to Alphabet, very low at 12%, so we will be expecting double-digit growth from this company. Free cash flow, again, it does follow the trend of the previous two, increasing, which is very nice, something you really want to see with companies, as well as the consistency. And even though we have noted the top line decreasing in terms of the percentage, still double digit looking very strong. And we also note 24% on a trailing 12-month basis, so we are anticipating 2024 to have more growth than the previous year. Numerically as well, it does look very strong. In terms of the shares outstanding, a little bit of a mix. In fact, they're not too far off what they started with in 2014 at 2.66. So we do note, whilst they have done share buybacks, they have also issued shares over the period. ROIC as well looking very strong, increasing manner as well, 32% on a trailing 12-month basis, does make it fairly attractive. And both margins, operating and free cash flow looking absolutely incredible, something that you can argue is very consistent with Meta Platforms. Finally, the net debt to EBITDA, pretty much right there in line with Alphabet, 0 across the board. It won't even take this company one day to pay off all of their debt net of cash on hand. Now the intrinsic value at $567, again fairly similar from Wall Street of 561, does indicate upside of around 16%. So if you are interested to see how we got this, we actually went with just one rate of 10%, which we do believe to be incredibly conservative. That is an average growth of 36% over the last 10 years, and just over 2023 we see 128% growth. Now, as you can see, that is how we got to the $567. But in terms of a margin of safety, at the 10% level, a buy at 510, at 15%, pretty much not far off the current trading price. So Meta Platforms near a 15% MOS with upside sitting at 16%. Before we move on to the final stock, we just want to throw in some ETFs today as well. The first one, if you didn't want to add the Amazons, the Alphabets, or the Meta Platforms, we have QQM, which is the Invesco Nasdaq 100 ETF. Now it is up around 20% over the last year, but as we can see over the last month, we do get a 7% pullback, and it is trading in the mid to upper end of the 52-week range. One reason why we prefer this to the standard triple Q, well, as we can see, the expense ratio is lower at 0.15%, and you do get a forward yield of 0.7%. Now, in terms of the holdings, well, if you're interested to see, we have the standard top holdings. We have Apple, Microsoft, and Nvidia leading the way. And one thing that we want to just show you here is that the expense ratio in comparison to others is much lower, 0.15%, the lowest end of these other alternatives. Then when we look at the performance in terms of total return over the last year, we can see 20.8%, pretty much in line with the best performing as well. Just something to consider, as we mentioned, if you do prefer ETFs as opposed to individuals, or maybe a balance of both, which is something that we also do in our own portfolio. We then move on to another company that we do believe to be high quality. It is Nvidia stock. Now, as we can see, insane performance, up 142% over the last 12 months. Incredible over the last 10 years at 22,000%. But as similar with other stocks, it has had a pullback of 12% over the last 30 days. Now, in terms of the ratings, a massive strong buy rating from Wall Street with a double hold. We notice in the mid to upper end of the 52-week range with a forward P that is now in the 30s at 39.2 and a forward yield that sits at 0.04%. Now, one thing with this company to bear in mind when we do take a look at the earnings, it is due to report after the market on the 28th of August. So that is something just to consider. And before we take a look at the underlying metrics, we just also want to show you they have beaten over the last 4 quarters and are anticipating around triple-digit growth to the EPS year on year. So if they do hit their January 2026 EPS estimate of 3.72, the forward P will come down to a much more reasonable level of 28.84. Now, one thing we just want to highlight, even if they do beat their estimates, we have seen many strong companies just over the last few weeks have a double beat and still go down in terms of the share price. And we've had the opposite show as well. We've had companies like Hershey, like McDonald's, with a double miss and actually go up. So something just to bear in mind. Dividend safety, 89, very safe. Not much to talk about. As we said, the yield is very low. And we also want to point out a 150% increase to that dividend just this year. Now, in terms of taking a look at the forward P historically, we do note fairly low in comparison, 37.5 versus 42.3. And when we take a look at the more important metrics for Nvidia, what we can see in the free cash flow per share increasing over longer term, although the largest growth has just been over the more recent years. Sales growth looking phenomenal again, at least double digit nearly every year. 2024 as well as the more recent period showing us triple digit growth. And we can in fact see their top line went from 27 billion in 23 to 61 in 24, and anticipated it's going to be much higher in the more recent annual report. ROIC as well looking absolutely phenomenal, increasing and 61% in 2024. And when we take a look at the margins, no surprises. This is a company not only increasing their top line triple digits, but over the longer term, we are seeing the margins increase drastically as well. Free cash flow well above 5%. 45 in 2024, a nice free cash flow machine. Finally, with this company, before we get to the valuation, like Alphabet, as we just saw, like Meta Platforms, not even one day to pay off all of their debt net of cash on hand. So let's get to our valuation of Nvidia, which hasn't changed from previous episodes. We get to around $140. As we can see here, Wall Street price target of 143 is higher, and they see 33% upside just over the next 12 months. We then have the 3 different growth rates as we just used for the other companies, 25, 30, 35. Now, why this sits higher, as we have gone from before, lots of analyst reports coming out, they see the AI market increasing between 40 to 45% year on year. And as we've taken a look at Nvidia's investor presentation, they see a lot of growth coming, not just in the chip market, but also when they take a look at robotics as well as other streams. And again, do check out our Nvidia videos if you want to see that in more detail. So 30% with that discount rate does give us an intrinsic value of $140. And if you believe the other rates are more applicable, you can see the downside as well as the upside. So let's get into the intrinsic value with an MOS of 10%, a buy at 126, at 15% around 119, 20% around 112, and we can see not at the 25% level just yet. So for Nvidia, at least 20% with around upside of 33%. As always though, do give us your thoughts below. Similar to the QQM ETF, there is also an Invesco semiconductor ETF that we recommend. Why we've chosen SOXQ? Well, it does have one of the lower expense ratios at 0.19% and also has a nice yield of 0.74%. Currently, right now in the midpoint, it has pulled back quite significantly, and even after the pullback, it is up around 24% over the last 12 months. When we look at just the last month, it is down around 16%. And then when we want to show you the holdings again, this is different to some of the others as Nvidia doesn't have as much exposure. Some ETFs in the semiconductor space does have Nvidia around 20 to 25%. As we can see, it sits at around 12, with Broadcom second at 11, and then we have AMD there around 7%. When we take a look at some others, we can see 0.6% expense ratio, 0.57, 0.35, as we mentioned, one of the lowest, if not the lowest, in the semiconductor space. And when we take a look at its performance over the last year, it is up around 25%, one of the better in comparison to some of the others. As always, let us know your thoughts about today's episode below. If you enjoyed the episode, value was provided, smash that like button, hit that subscribe and bell button. Don't forget to sign up to the free weekly newsletter below, and also join us on the Patreon by clicking on that pinned comment where we discuss our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.